Good afternoon. Welcome to the breakout session on sustainable finance. I am Alejandra Villota. I work on sustainability matters at the public policy team in Santander. And I'm going to introduce briefly this session and the three panelists we have today. The goals set out in the Paris Agreement require a joint effort from many stakeholders, from corporates to individuals, authorities and investors, to support the transition to a low-carbon economy. The transition must be just with those economic sectors, communities and regions that are going to be affected the most. And the financial sector plays a key role in supporting the transition by helping to close the green investment gap. We have heard a little bit about this morning during the conference, but over the next hour this panel is going to take a deep dive on these issues and discuss how the financial sector is contributing to filling the green investment gap, what opportunities and challenges lie ahead, and how the interplay between banks, policymakers and other stakeholders is crucial to make sure that we're setting the right agenda and roadmaps to ensure we get successful outcomes. So chairing the discussion, we're going to have Ana Rivero, who is our head of market strategy at Santander Asset Management, where she looks after the commercial strategy and marketing of the socially responsible investment products. Together with her in the panel, we're going to have Eila Kreivi. She's the Director of Capital Markets at the European Investment Bank. And among other, Eila currently is a member of a technical expert group that's advising the European Commission on sustainable finance issues on matters such as the development of a green taxonomy and the European Green Bond Standards. And finally, we're going to also have Peter Sweatman, who's the founder and chief executive of Climate and Partners, a strategic consulting group working with corporates and policymakers in the global energy transition. Peter has more than 16 years experience in climate finance, and he has been working with the European Commission, with the United Nations Environment Programme, and with the G20. And Anna, the floor is yours.
Okay, I don't know if I have to take this or this one.
Oh, you can use that one.
I understand. Okay, thank you everyone for coming, and thank you both Eila and Peter for being here. Let me start with some remarks on the panel and the things that matters today. We all know that we've come a long way since the COP21 in Paris, where we had the opportunity to negotiate, well, not we, but they had the opportunity to negotiate the Paris Agreement. And more than 190 nations came together to commit to the goal of limiting global warming to well below 2 degrees Celsius. As we know, a report from Morgan Stanley, for example, earlier this year said that climate disasters cost the world over $650 billion in the last 3 years, with North America absorbing 2/3 of the cost. On the other side of the equation, the United Nations Framework Convention on Climate Change stated that bold climate action could deliver at least $26 trillion in economic benefits through 2030, compared with business as usual. These are the numbers, and the numbers are really huge, and they tell us about the risks and opportunities. I understand that this is why we're here for the opportunities. The cost of climate inaction is too high and increases as time passes. Doing nothing is surely not an option. Addressing the huge investment gap needed to fund the transition to a low-carbon economy is an imperative on which we need to deliver in the next decade to avoid irreversible consequences. Over the next hour, we will be discussing with our two distinguished guests, Peter and Eila, how the financial sector is contributing to the greening of the economy, opportunities and challenges that lie ahead, and how the interplay between banks, policymakers, and other stakeholders is crucial to ensure the agenda and roadmaps are sufficiently robust in the tight timing ahead. And before we kick off, I'll go and put my investment hat on, as I belong to Santander Asset Management, the investment management arm of the group Santander Group, to tell you some data that I don't know if you are aware of. From 20 to 30% of all global assets under management are right now invested under socially responsible investment strategies. Globally, sustainable investment assets in the 5 major markets have increased by 34% in 2 years and amount over $30 trillion US. The split of global sustainable investing assets by regions show clearly that Europe is on the lead with 46% of the assets, followed by the US with 39%, and then Japan, which is at 7%, but has experienced an over 300% increase since 2014. And to us in our world, more important than this is the fact that retail investors are gradually picking up in that investment. In 2016, they accounted for 20% of sustainable investment assets. But 2 years after, in 2018, they reached 25%. So the share will continue to grow as investment options are more and more available to them. Santander Asset Management has been pioneering investment in sustainable and responsible funds, launching the first ESG fund back in 1995 in Spain, and we actually manage nearly 60% of the assets in ESG investment funds in Spain. Last year, we launched our full range of sustainable funds in Spain, which are available to any type of investor. It doesn't depend anymore on your profile risk. And there's much more to come. So now let's turn out to our speakers. And we will start our conversation maybe by asking you to give us some light on how you are working with companies, banks, and investors in the climate finance area. Eila, maybe we can start with you and your job in nudging private finance towards the sustainable goals. And how ready do you believe that European banks, with the ones that you work with, are now ready to deliver on that?
Thanks, Anna. Just to say that my work is basically I'm responsible for EIB's funding program, which is 50-60 billion euros per year. And with that, as we have been so much at the forefront on all these developments, has come a pretty visible role also in sustainable and green finance. Since EIB started all this green bond business back in 2007 already, which actually, to be anecdotal, when we did it, we did two novelties at the same time. We did this green bond with a dedicated use of proceeds for energy efficiency and renewable energy. At the same time, we used, which we thought was the bigger thing for the future, we used for the first time this European Union sort of passporting possibility of launching a bond, which was at the same time could be sold in every EU country. And we thought that this was the big thing for the future. Actually, nobody ever tried it after us. It was too daunting. so we did not suspect that actually it was the green side that would become the story in the future. It remained fairly small, as you know, until 2013, I would say, when it started to become more institutional as a market, and 2014, when some banks, 4 banks, started what is called the Green Bond Principles, which is kind of a coalition of the willing, if you like, on best practices in the green bond market. We joined them together with some other issuers, some investors as well, and we started that as a formal sort of platform in 2014 to work on guidelines how to do green bonds. Totally voluntary, obviously, because we didn't have any regulatory powers at all. But so I chaired that for the first 3 years when we started on a formal basis, and so EIB has put in a lot of work in all of these green bond principles, all of its dimensions, which start to be quite a few nowadays. And then when the Commission established in 2016 December the high-level expert group on sustainable finance, EIB was invited to be part of it. I represented them. And now this, as you mentioned, the technical working group. So it's been quite a lot that we have been involved in almost every initiative, at least on the European ground, in this field. Now, how do we work with banks? Now, EIB is not a retail bank, as you may know. We take all of our money from the markets. We don't have any retail clients or deposits. And what we do, I work on the liability side with banks, is of course the banks with whom we do our funding. Many of them are very active in this green and sustainable finance field, and we have worked together with them in these green bond principles in the working groups and so on. And I have to say that they're very, very different levels. Mm-hmm. Some people are what I've been hearing today from Santander, because I don't work that much with Santander on my sort of day job side. I think there's a lot going on, and that's really I'm really delighted to hear this. It's fantastic. And by the way, the theme trust, I think it was a really an excellent
Well
choice.
chosen.
Yes, indeed, it was a fantastic day. Then you have people who have, for example, Berliner Hypo. It is a mortgage bank in Germany. When they did their first bond, they were first green bond. They were so delighted with this response that they got, that they actually then gave to their network, the branch network, who sit in front of people negotiating mortgages, instructions to source green mortgages, so that they can do more green bonds. And they also give a small pricing advantage to their clients who do a green mortgage. They of course have some rules what qualifies and what doesn't. So they are very pro. And they are actually putting it all through to the client in terms of getting a better pricing. Then you have, I'm from Finland, and last week I read, this is all being streamed possibly, so okay, my regards to Finland. There's a different kind of a chairman of the board of a Nordic bank who said last week in the press that he doesn't believe in any of this multi-purposing of financial institutions, that their job is to increase shareholder value, and that's it. Okay, I thought when I read that this sounds 1980s basically to me, and I think that's maybe this is also even a generation question. I'm closer to that person's generation than the millennials, but I think that the sort of after-war generation may have been putting a lot of sort of focus on financial sort of safety and all this, because they lived through as kids harder times anyways. And millennials nowadays, if we talk about at least in the mass and class comparison that we heard today, if we talk about the class, those people there, the millennials, even if you don't come from a rich background, you are probably fairly comfortable, because your parents and grandparents will leave their fortunes to you. The generations are getting smaller. You don't have 10 kids anymore to share the inheritance. So you don't need to put this as the only and first and foremost objective in life. And I thought shareholder value, the way this chairman was describing it, he was clearly thinking only in money terms. But as we heard earlier today, how do you define shareholder value? Well, if there's a millennial who is a shareholder in this bank and a client or even an employee, they might think that, well, my shareholder value is actually something more. I want something more to be done with the capital that I have invested. And this is, I think, something that is seeping through. And I think there is a generational change there. And then some of us even some of us dinosaurs have sort of seen that there's this change going on. So that's a bit my take on it. And we do talk about very different dimensions. And for example, the bank that I quoted there, or the chairman rather, is from the Nordic region, who normally is known for pretty good sort of ESG reporting. For example, sustainability reporting of corporates is pretty good. Employee rights are pretty good. Women's rights are pretty good, and all of this. But this side, as I see it, is not quite as advanced as in many other parts of Europe.
Okay. So Peter, maybe we can share with you, or you can share with us, what are you doing in your jobs and maybe in the task force on climate-related financial disclosures, which is not very well known, I think, by the people, and then you can show us some light on how do you work there, what's happening there.
So I don't know, of course, where would an ex-banker be without PowerPoint presentation? So I did, of course, there we go. And I'm going to stand up too, because I have a slightly bad back. So first of all, if I stand up, I won't be able to see the two of you, so I'm not going to stand up. But
feel free.
All I was going to say is I'm particularly delighted to be here today because, as Peter Kreivi invited me, reminded me, the last time he had seen me, he was briefing myself and a managing director of Banco Santander in the year 2005 to go on Spanish television to talk about the joint venture that Climate Change Capital Banco Santander had just launched to drive value from the Kyoto Protocol. And we were explaining the Kyoto Protocol, and this bank was taking a lead, and he said it was the first environmental press release he'd had to work on. So I have to say, I'm personally extremely delighted. I actually had the opportunity to wear this great tie, which I was given by the bank at that time, at this conference, and particularly to talk about climate change and ESG in an environment that has changed a great deal, and you have clearly changed with it. So what I've done is I've just depicted on these pictures a little bit of what has happened, because I think sometimes where we are, particularly in a leading bank, sometimes we don't know where we came from and what has sort of happened. So what this chart, which I'm going to stand up and walk over to, describes is that, so I've been working in climate for 15 years, but the last 10 I've been running a firm, and the firm has been working both with policymakers and companies and banks, and these are some of the ones sort of noted down here we've been working with, on the different phases of their own evolution with their practices relating to climate change. So we began sort of way back, and I started working with Banco Popular, who of course now happily is part of this family, with carbon footprinting. So in those days, we essentially thought, as organizations, what we needed to do was figure out how much CO2 we each emitted, and then decide what our pathway would be for reducing that. So at that time, it was either carbon footprinting or it was climate change strategies in general. We did that. We then started to look at stakeholders, what they thought, and that's really early days. It was around the time that Sean was setting up the climate bonds initiative, which I advised, and we were thinking about what would debt issuers have to do to be compliant with policies and so on. But and then supply chains. So the companies like Inditex were thinking about, how do I green the people that provide to me? Because it's not just what I emit directly that counts. It's also the rest of my supply chain. How can I influence that? Then we got into the first time that climate risk started to really appear on the horizon for my clients, at least, was around 2013, 2014. And we started to look there. Green bonds, stranded asset conversation became a part of the picture. We moved to shadow carbon pricing, so I began to implement for our clients shadow carbon prices. And one of the things I discovered is, notwithstanding the great data that there is on those clients that are implementing it, very few of them have a sophisticated approach to it, and very few of them take those prices and properly embed them into their business unit. So fascinating discoveries to do with shadow carbon pricing, energy efficiency, that fabulous low-hanging fruit that very few organizations are able to pick. Although around that time, Santander's UK branch offices were all upgraded for energy efficiency, which is a transaction which was very interesting at that time. And then the TCFD, which you had mentioned, the Task Force on Climate-Related Financial Disclosure, really a 2-year effort that came to its conclusion recommendations in 2017, presented at the World Bank. And essentially what that was the first, I think, truly sophisticated approach, whereby not just the financial so I was surprised actually that not just banks, so it was essentially written as a guideline for asset and liability managers and financial institutions. But the very interesting thing is that so many corporates are now implementing the exact same framework, and of course we spent some time with Ferrovial over the last year helping them implement it. And what I would say about that, and there's a slide a little later on, so if you move to the next slide, I think, so bringing us now beyond the past and a little bit towards the present and the future, Nick Robbins and I published a report for the One Climate Summit in Paris, which talked about green tagging. Now, green tagging is something which I think is terribly important as a financial institution to think about. So this is really to do with imperfect data. So one of the things, the question of today's conference overall is one of trust. Can we trust the data on climate change? And how do we integrate the data on climate change, of which there's actually a lot out there, but it's sort of ragged data, into making sense to our activities and to the decisions we have to make day to day as asset manager or client manager or capital markets expert? One of the ways is to green tag. So essentially green tagging was, rather than saying we need to create a standard, we need to apply the standard, we need to wait and see what the data says, green tagging talks about, let's go through the historical data that we already have in whatever form that may come. Let's think of some theses that we think may be green, and let's track those theses through our existing data, and let's see if we can come up with any correlations that are interesting. And why is that interesting? Because I think that statistically it's so much more interesting looking at a mortgage portfolio that you've had on your books for, say, 20 years, and clients that you've been lending to or working with for, say, 20 to a couple of decades, and saying, are these clients energy efficient? Are these clients embedding science-based targets in their future portfolio policies? And if so, can we call them green or can we not? And if we can we identify any common themes about the practices and about the experiences we've had with them? So at the time we presented the report, there was this linking credit with loan pricing. I'm happy to say that a number of the financial regulators have gone off and commissioned their own studies on this. A number of banks are leading. We worked with 10 banks at that time. But today, I think we're in this process, and I know that the TEG has been working extraordinarily hard to publish the mitigation taxonomy. But in 2019, we really are where Nick and I projected we were going to be, which is building sort of market-wide norms as to how this green tagging was supposed to be an imperfect approach. Because I actually think we live in an imperfect world, and the solutions to climate change are many and varied depending on the institution. So without pretending we live in a perfect world, let's see what the data tells us. And then on the basis of that, let's see how we project that forward. So we will see, no doubt, policy and regulatory integration. I'm a big supporter of the green supporting factor as a way that we can have regulators tilt the playing field towards green assets for good analytical reason, as opposed to for ideological considerations. And if you go to the next slide, you'll see where I'll end is the Task Force on Climate Financial Related Disclosures. One of the things that I've noticed, so the thing that is critical, and the clients that I've worked with on this particular subject, the thing that's critical is this is not seen as a reporting process. This should not be seen as a process which is somehow external to the way your business works. This is intimately connected to your strategic planning and risk management. This is intimately connected to the way that you assess. And so if you have a corporate risk assessment model or a corporate risk management piece of software that reports regularly, say, to the board of the bank, then that needs to be, the results of this process need to be fed into the overall risk management system, so that the overall risk management system is seeing the outputs of the process. I'm sure it's the case here, but when we did that, and fundamentally when we forced the enormous working groups that we had inside of our clients to come up with the financial metrics. So one thing that this involves is scenario analysis. Scenario analysis is hugely imperfect. You have to go and figure out, where will my business unit be in a 1.5 degree scenario? Where will it be in a 2 degree scenario? Where will it be in a 3 degree scenario? Those are almost impossible questions to answer. However, there are data sets out there, and there are tools for integration within the context of each business that will allow those managers essentially to think a little bit outside the box. And the fascinating thing that I have personally witnessed is, as soon as you move the conversation from a compliance one, which is all about how do I do less and how awful this is and how much extra work I'm going to have to do, into an opportunity one, which is this future, which is the net zero 2050 future, is coming like it or not. Where will my business unit be in 2050, and what will we be doing, not emitting a single gram of CO2? That is a fascinating question, and that's the kind of thing which inspires.
Okay, that question that you are posing now, it's one that for us is also very important. And I ask both of you if regulation should reward sustainability or maybe punish if you don't comply with the targets that you maybe have. You can explain on the targets that you have, or how, from your point of view, is this going to be fair to everyone, so the access to being one of the top performers is the same or easy to all the companies that finally will be all of them that might be subject to that sustainability fund. I don't know if we can start with the targets that you have.
Well, just to talk about this, if market or regulatory environment sort of
rewards
or punishes. This was something which was quite heatedly discussed in the high-level expert group. This is not clearly something that regulators, supervisors are against without any further proof. You can agree on that, because if you say that my wind farm is less risky than your coal mine, well, with what time frame, it's impossible to say. You can't compare. It's apples and oranges in that sense. But having said that, yes, when there is a apples to apples comparison, then I think, just my personal view, I'm not a regulator, definitely not, then why not? If you say that there is a risk, why wouldn't you walk your talk? So for example, I think in commercial real estate, there have been some studies which show that if you have a good energy efficient building, they have better occupancy rates, they have better long-term tenants, and hence this is less risky than an old building which doesn't have the same characteristics. So in that sense, yes. But as for and Brown penalizing it's not something that has not really been worked upon, for example, in the technical expert group. This was just simply not in their job description, so it wasn't tackled because of that.
Okay.
But as for EIB, so well, we have long before this became a hot topic, we have been looking into the environmental, also economical, of course, and social sustainability of everything that we do finance. Largely, it's based on the European regulations and legislation, but sometimes we go further than that. Sometimes clients may think that we are more Catholic than the Pope, but we like to keep it that way, to be quite stringent in terms of what we call environmental. So that's how we see it, and then it is something that we intend to increase. I think we have already now announced a couple of months ago that we want to go from around a quarter to around half of our annual lending going to green climate and environment. I believe that is until 2025. And over the next 10 years, we hope then that with what we do, because we never finance something alone, there are co-financings, then we hope that what we finance will mobilize in total €1 trillion over the next 10 years, so let's say 100 billion a year. Okay. Those are the kind of parameters that we are looking at. This is very ambitious, but it also depends what is out there, because I think here Santander and EIB are pretty much alike. We don't go and tell our clients, this is what you should be doing, this is what you should be building, this is what you should be investing in. They decide, and then we finance, they ask for the finance. So one also has to keep in mind when we talk about what kind of financial sector banks do not take the decisions to invest or build. That's a whole different process. That's our clients who do that.
So you think that we all think, I guess, that this must be driven by demand and not by regulation?
Yes, exactly. And I think this is a general problem all over the world, but certainly in Europe, that there isn't enough of investment going on in any field. And that doesn't depend, that's not because there isn't money available, because we are all flush with liquidity. I'm sure I can speak on behalf of Santander as well. So money is definitely there if you have a viable project, but it's not the banks who mobilize it. We can only assess projects and investment plans when we get them in front of us.
Okay, that's a problem, of course, with the transition economy. Because if all the banks and all the lending intends to go only to green projects, then all the transition economy will be like in nobody's place, and they need the financing to become green. And then how are your thoughts on that?
So I was asked that. So I was sorry to late to arrive to the conference. I would have loved to have seen in the morning, but I was on a webinar where I got asked the exact same question from a European group representing industry, and they said, the European funds want us to pre-classify ourselves as being transitioned, and yet we need to finance our own transition and to play a role in the transition. So I thought that was very interesting. I also noticed that Dr. Masukato was talking earlier about the need for innovation investment. So I wrote a piece last year, actually, it was published about financing the innovation required for Net Zero 2050, whose conclusion is that we have, broadly speaking, 3/4 of the technologies that are required, and we probably need an additional 25% of budget invested by whom, in what? So the whom is most likely to be, so it's 2/3 private sector and 1/3 public sector, because that's the split on innovation investment in general. And the whom is probably likely to be large firms who have multiple business units, but they're the ones that typically do a lot of spending. And if you look at private equity and venture capital, as interesting as they are, they're just not big amounts of money. They're not the size. We need an additional 50 billion over the next financial framework period, over and above everything that's been currently committed or can be measured. And those investments are going to be the things that produce the technologies of the future. Now, the name of the report talks about funding for a competitive Europe, a competitive climate leader of Europe. And the reason why I think that we're, as long-term investors, going to be making those right choices is because those are the technologies that every other country in the world will want. So to my mind, net zero is a global phenomenon. A month and a half ago, I had the good fortune to attend the UN Climate Summit, and I think net zero is the conversation. When you frame this challenge as a net zero challenge, it suddenly becomes much more tangible, much more practical to the businesses involved. So to the question that you asked, how do those businesses transform themselves? And to your point that you earlier made, which is we work on the sort of demand side, there is a demand by society, I think, and by stakeholders, for businesses to adopt science-based targets. Science-based targets can be adopted by any business. They can be a financial institution, an infrastructure manager, they can be a utility. And what it essentially says is, I've thought about the trajectory of my business in the context of a net zero world by 2050, and I've laid the plans for that. And as a result, my interim targets of 2020, 2030, 2040, and 2050 are these. And this is the way that you stakeholders can measure you. So one of the green bond developments that happened this year by Enel is Enel has said, and I think financial investors have responded by saying yes, that if we don't meet our sustainability targets that we set for ourselves, we will pay you more as a coupon. But if we do overshoot our own internal sustainability targets, we will pay a lower coupon on our green bond. So it's green, and it's also got this kind of like attachment to the delivery against their own sort of targets. So I think that businesses can help, and I'm not saying that the answers are all there, because the interesting part of the businesses that lead this is they end up developing the frameworks that others follow. And there's nothing like, and I recall this from 10 years working at JP Morgan, there's nothing like leading in the development of a financial product to then have the advantage and to be able to then remarket to all of your clients and to be able to sort of roll that one out throughout all your teams so quickly as you would do in a global bank, to inspire and to support this transition.
Okay. You were talking, both of you, the need of private investors, because well, maybe if we rely only on public investment, well, you know, cycles and, you know, politicians and everything, so maybe this won't go on the pace that we all need, not to 2030. In our business, we are looking for retail investors to understand how important this is, the part that they have to do in greening the economy, but maybe is there where you could show to us, or you could tell us how can we do to convince, to make trust visible to retail investors on this type of economy, because institutionally I guess that everyone is more or less aware of what is happening. We all know who the actors and the drivers are, but to bring this to retail investors, who are the actors that you believe that can help from your companies, from your point of views? What do you think that is lacking to translate this into all the society and not only institutional investors?
Well, I think there's well, I don't work with retail, so maybe, maybe you tell me if this works or doesn't. But banks who have retail business, obviously, they work on both sides of the balance sheet, or give investment advice or investment products, and then also take deposits, give loans. So I could think, well, you can offer investment products which are green in whichever field. It can be funds, it can be bonds, it can be whatever. I think this idea of green mortgages with certain kind of thresholds and criteria to the client, giving a small advantage, even though I know the spreads are very compressed these days, but anyways, to sort of try to sell that idea as well. I think this kind of ideas is something that one could work with. And now I think some of the well, it hasn't been put into any regulation yet, as far as I'm aware. But the idea is, anyways, there on the EU side, that when you do investment advice for retail or institutional investors alike, you have to ask in the future also their sort of sustainability preferences. Because now, of course, until now it has been a question. I'm talking to you. I take your money. What's your risk profile? Do you need the money in 3 years' time, in 20 years' time, whatever? But in addition to that, now I should ask you, what are your sustainability preferences in investing? Yes, and when you ask this is a very clear message to the clients that this bank is actually thinking about these things and cares about this, and is directing it. Okay. But I just wanted to say about this transition, to say that there are clients who have to finance their transition themselves, and I think in this respect, if it has been unclear, or we haven't had definitions for this green, but we have had even less definitions for what is transition, and that is a really tough area. I think this is something that this famous taxonomy, which people have lots of concerns about. But I think if you bother to read it or look at it, it can be alleviated. But they have the approach that you have three kinds of activities which can be considered green. The first one is the obvious one, greening. Greening by. So this is the renewable energy, clean energy, and so on. But then there's another segment which is greening off. So this is, and this is the transition, i.e., heavy industry, which can be improving their systems and their production and their performance, so that they are also greening their activity and participating in the project. And then the third category, which is comes into what you just said, is the enablers, research and development, manufacturing of windmill components, whatever, which are not, the activity itself is not green. It's not a green perhaps to produce solar panels, or research and development research project doesn't, it's neutral carbon-wise itself. Maybe people sitting in a university laboratory doesn't produce carbon emissions too much. It doesn't save them either. But this is a very important sector. So I think there you have this, these three different groups, and I think it's important then also for the finance providers to this sector to say that I have been financing this R&D, this manufacturing of components, whatever it could be, and hence this is a green loan for me. And I think this labeling is very important to put on the table.
Sure, the remote standards that you have been working with, and that's very important. And we are developing our own rating system for green investment. And one of the things that we were talking with Peter just a minute ago is that from now on to 5 or 10 years, 10 years may be too much, but we will all need to speak the same language. I mean, it's not that we have our ratings and the one have his ratings. The ratings should converge to everyone and make them understandable to all the investors. You know? Maybe in trust, talking about trust, which is the theme of the conference today, we haven't been talking about greenwashing, which in the transition economy can be one of the themes, the themes that we all are aware of. What can you tell us about how this is evolving, Peter?
Well, if you'll permit me, just quickly. So I'm going to answer the question on trust.
Sure.
I'm going to answer the question on trust, but I'm going to go back to the retail because I want to just quickly.
Yes, forgive me.
So, broadly speaking, to deliver the Paris Agreement, we've got to do 50% of the activities on the demand side for energy and 50% on the supply side. So to everybody in the room who thinks that we can just go renewable and keep carrying on the same, it's not going to work in time. It would work perhaps if we had 100 years, but we don't. So we are going to have to work on the demand side, and the demand side just means doing things more energy efficiently. So the question to the retail investor is, so why don't you renovate your home? Because there are homes, I've visited them, and I've been one of the co-authors of many reports that have looked at the Spanish situation and the UK situation and the US situation about leaky, energy inefficient homes that are easy to renovate, but apparently there's no financial instruments, there's no, today, I mean, we're still defining the components of a green mortgage. So why don't you, any one of you, all of you, why don't you now renovate your homes? And the answer is probably one of three things. Number one, you don't trust your neighbors. Number two, you don't trust the construction company to deliver the savings that you think that there may be. And number three, you probably don't trust the government not to then change, or the utility to then change the tariff you want so that the savings that you might have had aren't realized. So trust, funnily enough, is one of the things that perhaps underlies the reasons why many of us who are keen haven't done enough with respect of where we live or where we work or what we drive. You know, so they're different categories, but one of the things that I can say, and one of the things that I think financial institutions can take a lead on, is I think it's not 100% resonant of the world that I know to say that financial providers or financial instruments don't have or can't have an implication on their customers' demand. I think it's a little bit more nuanced than that. So if you stop offering a particular product and you offer other products, then your customers will naturally become inquisitive. If you have the opportunity of European technical assistance, which is essentially free money that the EIB can provide to you in many cases, to go out and develop an ecosystem of companies that are willing to offer energy renovations, then our journeys, each one of us, would be that much simpler, because we wouldn't have to worry our administradora think as if we live in Comunidades Vecinos in Spain would come to us and say, here are the 3 tenders from the 3 companies that could renovate our home. They say we can save 60% of the communal energy, and each one of us can replace our gas boilers for a biomass or for a heat pump and so on, and these will be the characteristics of that. And then, fortunately, there are insurance companies out there that are willing to take the risk, the performance risk. So you can then buy an insurance policy at basis points or little proportion of the financial value to cover the technical risks, call it that the risks that when they install the equipment it doesn't work or it doesn't deliver against what you had expected. And then, of course, public financial institutions and indeed governments can provide you with the kind of policy regulatory risk protection that only they can provide. Because no one except for the government can say, I'm not going to change the policy that impacts the cost of the energy that you're having to pay. So there are new instruments which I hope will form a part of the new Green Deal which emerges, which is going to help us transition Europe and our societies. Because at the moment I fear that not all of society is fully, should we say, a player in the energy transition, and yet we are all implicated. Where we live is implicated in those plans, if you take them seriously. Where we work is implicated. Our cars are implicated, our activities are implicated, the companies that service the products and services that we want are implicated, our habits are implicated. I don't mean that by saying that we are to blame because it's our combined carbon footprint that is the thing that matters. I don't believe that anymore. I used to think that way, I don't anymore. What it means is that we have to more actively engage with the providers of those products and services to tell them that you want a decarbonized version or a green version of those products and services, because you know what? Yours and ours are the voices that they will listen to. Back to your point, that will create demand. So it's the message to all of you. And the reason I can say that with reasonable confidence is because I fundamentally believe with the technologies we have available, virtually all of the products and services that you want can be delivered to you with virtually no emissions.
Okay, so it's a question of demand, but we have to make something to arise the demand, no? More than it is, more than I believe. So back to the question of greenwashing, because it's something that really worries the people that have to invest. I mean, we channel through the money from retail investors, but we channel it through institutional investing, really, because we invest in bonds. In another question that maybe follow up is why there is such a lack of sovereign green bonds. Right? We would love to invest in sovereign green bonds, but there's not really. Only I believe it's only 16 or 17 green issues, sovereign green issues. So greenwashing in transition economy.
Well, if I could be provocative to the extent I haven't already been.
Not too much.
But what I would say is, if you're a green sovereign, Morocco could be a green sovereign. Why do I say Morocco? Because Morocco has an NDC, a national defined commitment under the Paris Agreement, which is aligned with a well below 2 degrees outcome. Not many other countries are. So to be a green sovereign, in my book, as a climate guy, you have to have a plan that is consistent with the Paris Agreement. Not many plans are. That's why the UN Secretary General convened everybody in New York to basically to say, guys, your plans aren't quite up to it. Can everybody get around the table and increase their rate of expectation? So again, thank you, Spain, for hosting the COP. And we'll be hearing in December, right here in IFEMA, the countries come back together to assess and to mutually agree, hopefully, improvements to their own plans. So with respect to green sovereigns, to be a green sovereign, in my opinion, and this is a personal opinion, not an institutional opinion, you really have to have a plan that's aligned with the targets and outcomes of the Paris Agreement. So that's sort of point one with respect of sovereigns. Then with respect of companies, I mentioned earlier science-based targets. So I do think that all companies can think in detail about the way in which, and I've been working with a Spanish company that has a science-based target. So it's the largest infrastructure manager in the world, and they manage airports and roads and things that aren't obvious in a green context, but they nonetheless have science-based targets. And again, having seen that process from start to finish, and I believe, and there are 200 to 300 companies doing this globally, those that are committed can make that happen. And I think those are the ones who will then find the followers and who will then establish the trust among their equity holders and their bond holders. And we'll see, will they go out of business as a result of their green credentials? I doubt it, frankly. In fact, most of the coal companies that are listed are going out of business currently, as far as I can work out. And it appears to me that gas providers are kind of next up on that list. So we'll see what happens. But I think right now, those companies that are demonstrating green credentials and are positioning themselves in the markets of the future are going to be the winners. And then the trust will be derived from the fact that they've delivered the economic returns, and indeed they've delivered against their own targets.
Okay. We've been talking about, maybe you have some thoughts on
Well,
that.
just on greenwashing, because greenwashing is just if we talk about the greenwashing in the bond markets,
Yes.
which I'm most familiar with. I think that there's been very limited amounts of greenwashing, actually intentional greenwashing going on, and emphasis on the word of intentional, because normally people cheat when they have something to gain, and here you just don't have anything to gain. You don't get a financial advantage. You actually have a big reputational risk if you do it badly. So for that reason, to me, the intentional willful behavior has been very little. There have been some mishaps for sure, things which just didn't go very well, and I think the end result was, for those who attempted it, was less than satisfactory, and some lessons were learned. I think for the market as a whole, they were actually good lessons because they created a lot of discussion. What do we want to see? What do we not want to see? And so on. So that was good. But I think it's going all the way more and more into the direction that if you want to be a green bond issuer, green equity, green whatever, you have to have a story that goes together with that. You can't be just otherwise I'm a coal company, but I do once a green bond because I did some improvement somewhere. My coal mines are more energy efficient. I mean, this doesn't fly anymore.
Okay.
5 years ago, it probably might have flown. It doesn't anymore. People are actually quite sophisticated, and not everyone, but there are enough of those who are, and who are quite loud as well, if need be. So I would not patronize investors in that sense that they don't know what they are doing, but they also have very different rules. Asset managers tell what their clients are telling them to do. So asset owners do decide themselves how they want to invest. But I think this whole transition question is right now, it's I was saying in another meeting that until the summer, the T word of the market was taxonomy, which was the Netflix next horror movie. It sounded to me at sometimes. And now it's transition. What is transition? And again, we are talking about what is transition. And then my view and EIB's view is really that we should really keep that word for the real transition, going from current place to the Paris-aligned path, and not being something which is a little bit makeup somewhere. And we welcome the makeups even because they are all improvements, but just don't call it that because it isn't. That's all I'm saying. So it's a very multifaceted surface that we have here. We have the very green ones, we have the real transition, we have the better brown, maybe we can call it better brown, let's say, and then there are people who don't give a toss. Brown. Yes, and I don't know how much we have to move everybody towards the other end of the scale to get to the alignment, but we have to move a lot.
We have to.
And only if you, for example, if you take a look at the taxonomy proposal, it's still a proposal, which is a work of technical expert. What they propose, for example, for the heavy industry, steel and cement and aluminium, I think they put in there at least, where they put the bar, it's pretty high. But this shows that this is an urgent problem. If we had, like you said, 100 years, it would be much lower. But they put it here, and it's there for a reason. So yes, we need to clean up a lot.
Okay. I will be asking you again and again, but maybe it's time to take some audience questions if you have any. Anyone wants to ask something to the speakers? Yes, please.
Yes, I have one, and that's for the EIB as a matter of fact. Do you set yourselves any targets in terms of the own coloring of your balance sheet? So I suppose because you mentioned something that somewhat surprised me. You said it's on the you just finance, and it's for the clients to decide what they want to finance. But don't we have a role as a bank to help that transition? And if that is the case, do you have an own assessment of what the EIB color balance sheet is? And do you have targets? If you have a color, do you have targets for that?
Yes, absolutely. Thank you for the question, so I can clarify the point. Maybe it didn't come out very clearly what I meant. What I meant is that we have, of course, our targets, and when a client comes to us and says that, look, I want to improve the energy efficiency of my factory, for example. Yes, we will talk to them, and we said that this is what you should be doing if you want to sort of call yourself, for example, energy efficiency. If you improve 10%, we are not calling it energy efficiency. Improve 50%, and then we'll talk about it. So in that sense, yes. What I meant is that if that we can't go to a client and we said, by the way, your factory looks a bit run down, wouldn't you do the improvement? They have to decide on that. We don't give that kind of advice or we certainly don't tell them. So this is what I meant, that those people who take the decision, they will have to have enough of belief of faith in the future that this is an investment that will pay off. There we can't really play a role.
But if you'll permit me, I think one other answer, so I was focusing a lot on your new energy lending criteria. So the EIB has a deep and thoughtful process been running for a couple of years now, with some public consultation involved as well, to come up with the management's proposal for how it will allocate its energy lending resources. The EIB is such a market influencer, let's call it that, because rarely will club project finance deals go ahead in certain sectors without the EIB, or the EIB's presence merely will be a very strong encouraging signal to other banks to bring them on board. So what the EIB decides it will and won't do in energy is an incredibly important signal, if you ask me, to the private sector and the other IFIs. Now, those energy lending criteria are currently at the governance board level of the EIB, where they have to be approved by the member countries. And I, for one, am a strong supporter of the management team's proposal, which is very much in line with the transition. It's yet to be approved, but I think when it's improved, which I very much hope in the current draft wording, I think that'll be a strong signal. I really think that will be a way in which EIB can lead on this agenda.
Yes, I can only agree. I'm a strong supporter of it as well, as you may have guessed. but yes, it's indeed for the member countries, of course, to decide. It should be next week, I hope.
Mm-hmm. Okay. Any other question?
Maybe do you see green hydrogen to be a solution going forward? We're still not there yet. And you mentioned that probably the next one going out of business will be the provider of gas, and actually the pipeline could become the battery that somehow with hydrogen that we don't have.
Thank you for asking the question, because the hydrogen question is, so there have been topics that have come up in the climate discussion, sort of like they go in waves, sort of like hydrogen is the latest wave, and a conversation like this wouldn't be complete without the hydrogen discussion. So I think there are certain hard to decarbonize industries that you mentioned, and the metal working industries and some of the other process-oriented industries, where you look at the abatement costs and some of the solutions that are available, and you come up with hydrogen as being perhaps what would appear to be a cost-effective solution. I absolutely hope. So as I project Spain forward, we have a 100 gigawatt pipeline of photovoltaics in the system. We already have an electricity system that's got double the capacity that it needs. So even if we closed all coal today and we took the load factors of 30% of the gas down to even lower than the historic lows that they're already at, I think Spain's going to be producing lots of renewable energy, particularly around the sunny times. And around the sunny times, it will be curtailing that energy. It will be just producing too much. Now, that's not a crisis. We don't have to sort of worry about that. That's going to be perfectly normal in the future that we have planned. There'll be times where wind will be curtailed. There'll be times where solar will be curtailed because there won't be enough demand. But at that time, that power will be free. So when there's free power, the price of green hydrogen is going to be low. So there will be a storage mechanism in the production of hydrogen. Then the question becomes, to the secondary part of your question is, so where do you use it? I've said hard to abate sectors. I have notionally steered clear of transport and some other more sort of difficult questions. I don't know what the future of transport is going to be. I suspect there may be an opportunity for hydrogen in heavy goods vehicles, for example, or maritime, certainly. So, or even in planes, because it's quite light and etc. Sorry?
Aviation.
Course,
aviation, yeah, of course. So, but I haven't seen, I'm yet to sort of experience that for myself, but I don't rule it out as a long-term solution. Mid-term, your question is, with all the pipes we've got that's currently carrying sort of natural gas, mineral natural gas, could we just fill them up with hydrogen? That'd be fine, because it sounds like an easy solution. I think the answer to that question is not quickly. And I think that there's a danger, given that we've got only 10 years left to solve the climate issue, that we get ourselves unnecessarily comfortable with a sort of an easy fit solution that's not real. And so I think until hydrogen is more developed, and until we have more hydrogen usage on the demand side that's asking for it to be delivered through the networks, we can't answer the network question.
Oh, lots of questions.
On the topic of regulation, do you think that bank regulators will provide capital incentives to green lending? And if so, are there tools, credible tools and objective tools to measure such a capital benefit?
I think this comes to the green supporting factor. I think that was put on hold for 4 or 5 years now. It was discussed in the high-level expert group, but I think it's now EU or the Commission, they agree that we put this on hold. We'll see if we get some supporting evidence that there is, in fact, a risk difference, and then regulators would react, or supervisors, but they will not do it. I'm pretty sure that they will not do it unless they see evidence that there is a differential in the risk.
If I may, we heard it in the main room. There is a risk that there is a perception of the increased politicization of the regulatory mandate. It's critical that the regulators maintain their true and firm course to ensure stability, inflation targets, and the monetary and economic policy that all businesses and all economies need to continue. Now, can there be evidence which could produce a world in which there was a different regulatory treatment for green assets versus brown assets? Personally, as I mentioned earlier, I believe there could be a justification for that. Now, what's interesting is, if you're a financial institution that already uses your own internal IRB models, you could already have identified that, and you could already be using that if you could provide the evidence to prove to your regulator that that was an appropriate and conservative risk approach to your own capital assessments. I'm happy to be involved in a working group that's trying at the moment, together with the United Nations Environment Programme Finance Initiative and the European Commission, to try and pull together all the evidence that we can find from any financial institutions to provide the backbone for the kind of evidential inquiry and evidence-based decision-making that would require. So I treat it very seriously. I think that the evidence should be there, because given what Anna had said earlier, I always write this down because I write it down the other way around. You said 30% of the planet's funds are measured with some ESG criteria. So I wrote down 70% are managed irresponsibly. So if 70% are managed irresponsibly in the world and over half in Europe are managed irresponsibly, luckily 40% of the Santander ones are managed irresponsibly. So Santander is quite responsible in that regard on that scale. So I guess there's a role for the regulator there, isn't there? Because if there is, because again, we talk about responsibility and ESG responsibility as if being responsible was an option. It's actually not an option. We have to be responsible, and our regulatory frameworks are designed for that purpose. So if, as I hope and expect, we will get more trustworthy data, we'll get more of a flow into these types of responsible asset and responsible practices, there will be a role for the regulator in ensuring that there are not irresponsible actors out there.
Yeah. And also this data, we have been talking about this topic for maybe 2 years, but the data does not really exist yet. It has to be a bit longer and more than just anecdotal evidence. But I think it's also central bank, as you know, this network for green financial system is looking into systemic risk caused by climate risks within the banking system. And in that sense, of course, if they conclude at some stage that there are risks that should be taken into account in the banking sector in general, it may lead even to some penalizing factors, not whatever they will call it, but there will be then, for example, demand for additional capital if you are very exposed to those systemic risks.
Yeah. We have a question there, and then there was another.
My question has to do with, I have heard that EIB could be part of this new Green Deal that is commented these days, no, as a solution or as a part, no, for the fiscal stimulus, no, that everybody is demanding. Because of the monetary policies exhausted, no, in some way. So this new Green Deal, what could be the role of the EIB, no, in size, no? Do you have any plan, not any announcement, no, here, of course, but if this is realistic, or do you expect any change in your role in the short term?
Well, we would do, well, the Green Deal has not been defined very much in detail yet, as far as I know. Our role is, we are a bank, we finance. at different risk levels, senior risk going to equity level of risk and all of that. That's what we can provide. So we can't bring all the solutions to the table. But yes, we have, well, we already regard ourselves as the climate bank of the EU. This is what President Macron was last winter. I think he said that we should have a climate bank, and then of course EIB raised their hand and said that we are already the climate bank of EU. And hence the commitments to do more in this field in the future. Exactly the role is still to be seen, because the whole package is still open. Even the Commission is has not taken their functions formally. But yes, we will have a role, and of course the role is closely linked to what we do, i.e. finance.
I don't know if there's another question, because we're just on time right now. So maybe I should just thank the both of you. I think that you have made your part on bringing trust to the to the climate finance, the climate world in investing, of course, which is to us our main financing and investment. And thank you all for being here. And I will ask all of you to talk about this issue when you go back home, not only at your work, as Peter was saying. Talk about this home, because we have to be the part of the society that makes awareness to the other part of the society. So thank you all for coming, and thank you all for being here. Thank you.